All right, what is up, traders? What's up, tycoons? Super excited to see you guys. Lots to talk about in today's video. We're going to go over why the back half of April is so strong. We're going to talk about how stocks have been starting to fall from their all-time highs. And we're going to break down what it is that you need to pay attention to, whether or not to see the breakout continue to the upside or the breakdown continue to the downside, right? We're going to go over a couple of market breadth instruments, really good stuff that I'm excited to share with you guys. We're going to go over the new lows breadth dashboard, right? And we're going to kind of cover some breadth in today's video. We'll talk about the 10-day VIX in geopolitics, okay, and how you want to ignore that when investing. And then we're also going to take a look at some different metrics, okay, just to cover a different few things as we talk about the S&P 500 and the bond market in TLT. Gasoline very closely follows inflation expectations measured through this ratio here. We'll talk about this. We'll talk about the signals that the Japanese yen is signaling for bond, and we'll talk about what copper is potentially signaling here for bonds as well. So going to be lots of good video content in the video. We'll talk about what happens when the S&P 500 sees the 10-year yield cross 5%. We're pretty much on the verge of that right now. Essentially, we're going to be targeting 5% if we're able to break out and hold above 4.7 on the 10-year. We'll get into the details of the technical analysis later in this video and take a look at TLT and also go over the Russell 2000 and small caps, what typically happens with those when the 10-year yield crosses 5%. We'll take a look at the different small cap sectors that have been leading so far in the first quarter. And then we'll take a look at small caps themselves via the Russell 2000, the small caps, or the S&P 600 small cap index, okay? They're built a little bit differently. These stocks have to actually be profitable versus the Russell 2000 contains many unprofitable stocks. So a couple differences. As always, though, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. And if you're new to the channel, I started a completely free newsletter for you guys called Investment Intelligence, giving out free finance and trading related content to the markets. And you can go and check out the website, okay, because there is a website associated with it, and read some of the previous articles. I even try to sprinkle in free trade ideas in there. All right. And it's just something I do when I can. I'm trying to manage a bunch of other things. And, if you want some content that I'm not necessarily putting out on YouTube and you would like it directly to your email inbox, you can sign up for that using the link in the description, or you can sign up for the Investment Intelligence Discord. Okay. That's where I post all of my different analysis, all of my trade ideas, top stocks I'm watching. Basically, every single week I post about 20 plus swing trade ideas. And if I'm able to spot some type of day trade entry or potential scalp or things like that, I try to point that out as well in the Discord. It's only $10 a month, so it's very reasonably priced. I know not lots of YouTube viewers are millionaires willing to pay thousands of dollars just to see what other people are, trading and what they're interested in. Okay. These are what some of the previous trade ideas have looked like last month. Back in March. We'll go ahead and update this once April is over with some of the April trade ideas. But Tilray was a really great trade idea. 3-to-1 risk reward ratio. Went way past our bullish price target. Closed those out nicely. VLO was another one with a 2-to-1 risk reward ratio. Went back when it was in the 140s, targeting 166, 167, and it broke out way past that all the way up to 188. Energy was a really good play last month. But let's get into the video here and talk about some of the metrics. Now, since 2000, during the first half of April, stocks don't do much. All right. Then as soon as you get past April 15th, the second half is usually strong. Now, in my opinion, there's a very strong reason for this. Now, the reason for this is because of taxes. Okay. In my opinion, and also via data, if you just simply take a look, right, and we were to move my head out of the top right half down here to the lower half, you could see that on tax day, April 15th, that is typically when we see a bottom in the month of April, right? And it's not really a coincidence to me, right? I mean, I know I personally sold some stuff for tax purposes, and you have to think, right? All of the people that were tax loss harvesting, right? People always take that into consideration towards the end of the year. What about the people who necessarily didn't have tax loss harvesting available to them, right? Maybe They were in the fortunate position that their plays were green, right? And they're actually in profit. Well, they're not looking to sell at the end of 2023 to have to pay taxes in 2024. Maybe they're going to wait, right? And they're going to wait, and maybe they're going to try to use some of that income from selling their stocks and selling their gains to pay off their taxes on April 15th, right? And so it's just something to consider, but to me, it's not really a coincidence that once you get past April 15th, the second half of April is usually strong. All right, and this is the historical trend, the average path since 1985. And you can see that taxes do seem to have some type of implication to the market. Now, stocks have been starting to fall from all-time highs. This is the percentage of S&P stocks down 10%, 20%, 30%, 40% from all-time highs. And, we're seeing that increase here. Okay, so as you're seeing this increase, that means that more stocks are falling 10, 20, 30, 40% from their all-time highs. That shouldn't be a surprise. This is what's going to happen during a true breakdown, a false breakdown, right? Or a consolidation zone. You're going to see the market overall, right? The S&P 500 or the Nasdaq kind of consolidate and move sideways rather than flush to the downside whenever you don't have stocks making new lows, right? And that's something that I wanted to bring to you guys' attention. Is you want to pay attention to, a lot of people look at the percentage of stocks making 52-week lows. Some people look at 1 month lows. Some people look at 6-month lows, 3-month lows. The layout I have right here kind of just shows them all. And if you take a look, last week we saw the highest amount of stocks making 52-week lows that we've seen in 6 months. We saw the highest amount of stocks making 6 months lows that we've seen in 6 months. And we've seen the highest amount of stocks making 1 month lows in 3 months, right? And so this is market breadth, okay? I have many videos on market breadth and market internals on my channel. I have a playlist dedicated to that. But what we're looking at here is we're just seeing breadth deteriorating. And so this is just confluent with a strong downtrend, right? With a justified downtrend. So you guys see this little bit of choppy period right here in the S&P 500, right? Where we're basically just kind of trading in this range, looking to see if we're going to break support. Well, that's when we were not making new lows, right? Via 6 months, 3 months, this is actually supposed to be 1 year right here. That's a typo. But anyways, once we saw that, that's when we saw a very quick flush in the market, right? We saw a huge push down in the market because now stocks are making new lows, and we're seeing the number of new lows increasing. So this lets you know that this downtrend is actually justified, okay? And if you want to know potentially if we're going to make new lows, right, in order for us to make new lows, stocks need to be making new lows. It's that simple, right? And that's why market breadth is so powerful, whether it's 52-week lows, 1 month lows, or 6-month lows. If you see this breakout from the recent highs that we had, this means that stocks are continuing their downtrend, right? But if we continue to see the new lows list go down and we're not seeing new lows come into the market, we're not seeing a higher amount of new lows, well, then the stock market is not actually, justifying its downtrend, right? Because you can't justify a downtrend if stocks aren't making new lows. It's just that simple, right? And the same thing goes for new highs. If you take a look, we had a divergence, right? Where the market, was making new highs throughout this period, and we just continued to see new lows, right? Or a lower increase in the stocks making 52-week, 1 month, and 6-month highs, right? And what have we seen here recently? We've started to see an uptick in new highs via 1 month, 6-month, and 52-week, aka 1 year, as we've seen this bounce in the stock market, okay? And so what we really need for this to continue, right? If you're a bull, you really need to see the number of stocks making new highs, not necessarily too much on 52-week highs, okay? If you're looking for a little bit of shorter term, you really want to see the 1 month highs continue to rise, okay? If this can continue to rise, that's going to lead to 6-month highs continuing to rise, and that's going to lead to 52-week highs continuing to rise. So these are some of the market breadth components that you guys really want to be paying attention to, and that I'm bringing to you guys' attention right now, right? If you take a look at this is just another layout to look at the same thing, and it really helps visualize what the point necessarily that I'm trying to get across, right? Take a look at this. Stocks making 52-week highs. This peaked, okay? And when did this peak? This peaked about a week or two before the stock market peaked, right? And after that, we did not see more stocks making 52-week highs, right? What did we see? Well, we saw the S&P continue to go up, but we actually saw the number of 52-week highs go down. So if this S&P is making all-time highs, but you're seeing less stocks making 52-week highs, that's a little bit of a warning sign to you, right? It's like, hey, the market's continuing to go up, continue to make new highs, but we're not seeing stocks when you actually count the stocks, right, and go on an individual stock basis. We're not seeing that same follow through. And so potentially what we could be seeing is just a little bit of carrying on, right, where stocks are green a little bit. They're not really breaking out, making new highs, but they're green enough to continue to propel the S&P 500 higher. And then what do you see during this period here, right? Let's go and highlight this specific period here, right? We have this massive fall off. Okay, we have this massive fall off here to basically right here. Okay, and what do we see in that period here? All right, if you take a look, remember this is stocks making 52-week highs. No stocks, almost no stocks at all throughout this time period here are making 52-week highs. And, we're seeing a huge downtrend in the market, right? And then that starts to shift, right? The next week that shifts, right? Or the next day that shifts, and you see that the stock market bounced, and we actually had a few stocks making new 52-week highs. And then we got a little bit of a bounce and some consolidation today, and we see a slightly lower number of stocks making 52-week highs. If you want the stock market to go higher, you're going to need to see new highs in stocks. It's just that simple. Remember, SPX, the stock market, is just a market of stocks. So oftentimes you have to go down on an individual basis to really understand and see what exactly is happening in the market. Okay, and this is just using market breadth, right? Now, when you take a look at the new lows breadth dashboard, this is the S&P 1500. So small caps, mid caps, large caps, all of it, right? What are we seeing? We're seeing basic materials, communications, consumer secular, consumer defensive, right? A lot of these areas, we're seeing lots of 10-day lows. Okay, so 10-day lows is basically 2 weeks, right? 1 month lows is basically going to be 20-day lows, right? That chart that I was just showing you guys, 126 is going to be your 6-month lows, and then 252-day is going to be your 52-week lows, right? Because these are trading days. They're not exactly how many days there are in a calendar, but how many trading days are available. And we saw this expanding, right? We saw this expanding over the past couple weeks, and now we're starting to get a little bit of a bounce. But the big question is this just a bounce, or is this, a bottom potentially, right? And one of the things that was leading to a bounce was the 10-day VIX change being at extremes. So you have the VIX right here, and then you have the 10-day VIX rate of change, right? The ROC, and it hit extreme levels. So this basically just means that the VIX just exploded up out of nowhere and came to an extreme level that oftentimes we see many tops at, right? If we were to highlight them specifically, okay, and just try to draw arrows to them, right? We see a top over here, and then we start to see the VIX decline, right? We see, a top over here, and then afterwards, we start to see the VIX decline. We see a top over here. Shortly afterwards, the VIX starts to decline. See a top over here. Shortly afterwards, the VIX starts to decline. And we've seen a top here, and we've already started to see the VIX decline a little bit. So, this is another thing that you want to pay attention to, right? The VIX is not something that is trendy, okay? And what I mean by that is that it's pretty much in an everlasting long-term downtrend. But you get these periods of increased volatility in the market where it will see, short little uptrends, right? And you get these uptrends and they often come very quick and very extreme. And then the VIX starts to cool down a little bit and oftentimes sees a dramatic drop in the market or in the VIX. And then if that trend is going to continue, you'll see another really big spike and then another drop and then another really big spike and then another drop. That's how the VIX moves, right? It's not very bullish in terms of trend whenever you look at it, right? I mean, just this chart alone right here kind of shows you guys exactly what I'm talking about, right? If we're just speaking specifically on trend, downtrend, right? Downtrend, downtrend. But in between those downtrends, you have these extreme spikes in volatility, right? And this is very common to see. And sometimes you see the VIX do something like this, right? Where it just continues to rise and rise and rise. But the VIX doesn't last forever, right? It's not going to stay in an uptrend forever. And that's one thing you have to remember. So whenever you see these extreme changes in the VIX, oftentimes those highlight potential, short-term and sometimes long-term opportunities for investing and for trading. Now, I know there's been lots of stuff happening in the world geopolitically, but what you want to do, honestly, as an investor is ignore geopolitics when investing because the S&P 500, its median performance is a 13% gain. Now, this is 1 year after the performance of, all other instances in the market, okay? And so, you're basically a year out from all of these, crises and geopolitical events that we have. The median return is about 13% on the S&P 500. So there's been many times where the stock market has actually gained and performed well. And oftentimes these can just be short-term negative catalysts that really cause a massive spike in the VIX, right? And increase volatility in the market. But over the long term, the market doesn't pay too much attention to this, right? It's a short-term catalyst, but not so much of a long-term catalyst. And even when you go back and you look at the stock market performance during times of conflict and war, it's more of a bullish signal than a bearish signal. Okay, it actually stimulates the economy. Now, this right here is going to be the U.S. Gasoline Fund on the top, ticker symbol UGA. And then we have inflation expectations measured by a ratio chart of TIPS versus IEF. Now, TIPS are going to be your Treasury inflation protected securities, and then IEF is going to be a bond ETF. Right. And so when you're seeing this chart go up, it means that inflation expectations are higher. Right. And if you notice, this chart tends to lag a little bit. Now, when I say this chart, I'm speaking about UGA. Right. So what do we see here? A peak in inflation expectations, right, at this time period. And then what do we see? UGA gasoline actually continues going higher in price. And look at where we're at right now. We're seeing inflation expectations breaking out, but gasoline UGA has not broken out past prior cycle highs yet. So is this a sign, as it was in the past, that UGA could catch up to where the inflation's expectations tip IEF ratio chart is at and where it's headed? I think so. And I think it's a reason that you want to continue to pay attention to energy right now, because if we see a massive energy spike, which we haven't got that right, we've seen a nice boost in the price of crude oil, a nice boost in energy stocks and in the energy sector, but we haven't seen a massive 70 to 80% increase in the price of crude oil. And typically, once you get something like that, it normally causes a recession, right? Whenever you get those very extreme changes, right? And you see those really extreme rate of changes in oil and in the price of energy. And so we need to pay attention to this, right? Could this just be a false breakout, right? And then this rolls over. That's what the bulls are going to want. They're going to want this to roll over and be a sign that, hey, UGA is not going to break out and make new highs. But as we saw, even when this thing rolls over here, plenty of time ahead, we ended up seeing gasoline continue to rise up. So if this is going to happen, there's two things you need to think about. All right. Number one is going to be inflation, right? Normally, inflation is a very big factor to people's portfolio in the current market environment that we've been in for the past 2-3 years. And if inflation is coming hot, that typically has a negative impact on the stock market, right? Overall in general. And then, number two is going to be, well, what usually happens when energy prices are spiking and energy prices are going up and, crude oil is going up? Well, you typically see the S&P 500, which is very heavily weighted in tech stocks, go down. Okay. And so there's really two reasons you want to pay attention to the chart is, hey, this could be bearish for stocks if inflation goes up, because that's been bearish due to Jerome Powell and the Fed policy that we're in. Higher inflation reports is bearish for the market, but also, rising crude oil is generally bearish for the market. That's not always the case. So this is a very important chart I think you guys need to pay attention to, which is why I'm sharing it with you guys, okay? Now, when it comes to TLT, okay, that's another thing that you need to think about here also, okay? So actually, we're going to go back to here. Number three, if inflation is expected to go up and energy is expected to go up, what's that going to do for bond prices, right? It normally has a negative effect on bond prices if rates are going to go up. In this market environment, that's going to mean a higher for longer policy from the Fed, which is going to mean rate cuts are not coming, which treasury bonds are directly affected by the price of treasury yields. So if treasury yields are not falling, it's impossible for treasury bonds to go up. It's just that simple, right? And when you take a look at some other signals, we have, a nice little chart here of the Japanese yen versus US 30-year bond futures. And what do you see, right? You see that the Japanese yen has been in a continued downtrend, that these two charts mirror themselves very much. But anytime there's been a negative divergence, and the divergence signal is from the Japanese yen, where we start to see bonds rallying, but we see a period where the yen is continuing to decline, that is often, in the past few years, has led to declines, right? In the past 3-4 years, has led to further decline in bond futures. And if the Japanese yen is now making new multi-year lows, and bond futures have not made new multi-year lows yet, to me, I mean, this is a signal that does not look good for the bond market. When you look at TLT and you compare it to copper futures, anytime you see a negative divergence from TLT versus copper, right, where copper is going up, but TLT is going down, you see that ends up being a signal for copper that copper could pull back, and that the downtrend in TLT actually is going to continue. We've seen that over here, as noted here, and we've seen it over here, as noted here as well. So I'm looking at this wondering, hey, could copper futures potentially come down, or is it going to continue this divergence? Even if it does, it generally just means that the downtrend in TLT is going to continue. And if we actually start to see a downturn in copper futures, we could also see a downturn in TLT. So either way, using copper as a measurement, via divergence or via normal intermarket relationship, it doesn't look good for TLT here, right, for bonds. And so when you take a look at the stock market, when the S&P 500 crosses 5% on the 10-year yield, the forward 3-month and 6-month returns, they're not bad, okay? They're not terrible, all right? If you take a look since 1978, in all periods versus, just in all periods on average, it's 2.3 to 4.8% returns. But after the 10-year crosses 5% since 1978, it doesn't look the best, right? I mean, these aren't horrible returns, negative 1.8% and negative 5.8%. But, and so while it's not a market crash or like a bear market necessarily, they're definitely not great returns. All right. And that's what the problem is right now. When we actually take a look at treasury yields, they're on the verge of breaking out towards 5%. Now, there's still plenty of work to be done. Okay. And the S&P 500 has already corrected 5%. But we spotted the cup and handle here on the 10-year yield. And we pointed it out to everybody and said, hey, look, we're getting it even in the last video, right? We're getting a breakout retest of that neckline. Be careful if this fires up. We have 4.535 and then 4.7. And that's exactly where we topped out at. It was 4.7. But look at what we're doing now. We're bull flagging, right? This is literally bull flag consolidation here. If this consolidation resolves in a breakout to the upside, we're most definitely going to fill this gap up here at 4.78. And then also, it's very likely that we're going to continue heading upwards to 4.9 to 5% on the treasury yields. And then at that point, you have to look and you have to say, wow, well, now we have a huge giant base. What's going to happen here? Are we going to pull back and check back for a cup and handle and then break out? Or is this going to turn into a double top, right? Where we have a top over here and then a top over here. And at which point treasury yields will need to break all the way through 3.78 for this to be a confirmed double top that actually breaks through the neckline to head lower. So, while this could roll over at any moment, this is an area that you want to be extremely cautious, right? And if you're trying to long bonds, there's no reason to necessarily long bonds at a point of uncertainty when yields are bull flagging, potentially about to break out, right? You want to look for the, consolidation zone to resolve and a move lower potentially, right? And even when you look at TLT itself, we talked about how important it was for us to get above this 618 retracement, right? And the reason being is because the odds increase drastically, right? The odds drastically go up whenever you are below a 61.8% retracement of getting a full 100% retracement. And we've already spent almost 2 weeks below the 61.8% Fibonacci level. And, we had the chance yesterday to really break out above it, right? We've tried multiple times, like 1, 2, 3, 4, 5 times to really break out past this level. And we haven't been able to do so. I was looking for potential long entries, if we can break out above here. And we also had this inverse bump and run pattern, right? With a prevailing downtrend and then an aggressive bump to the downside in price. And the run is actually breaking through these two trend lines and heading back up to where the pattern began in this zone up here. And it appears we got a little bit of a false breakout and we're coming back down to those levels. So as I mentioned, you really want to see TLT get back above 89.50. Okay, 89.42 is like the precise level I have, but 89.50 is generally the area where TLT needs to get above, right? It needs to start trading above there for any hope of a turnaround. The more time we spend below 89.50, the likelihood increases, as I mentioned, significantly that we get a full 100% retracement back down into the low 80s to retest the new lows. Keep in mind that the next price level below is going to be right around 86. I think it's like 86, 85, something like that. If we break that, there's still a gap down to fill at 85.26. Months ago, weeks ago, I was warning you guys, hey, there's a gap down here. Hey, we have another gap down here to fill. And now we have this gap. We're very close to filling this 85.26 gap. We're only about $3 away, less than $3 away on the TLT, 3 points away. So it's something that you need to be very mindful of, right? Now, I'm not saying just because we're below the 61.8, below 89.50, that we have to come down all the way down to get a full 100% retracement and potentially even break and make new lows. But when we take a look at some of the different measurements, right, such as the ones that we looked at here with UGA and inflation expectations, seems like this is breaking out. When you look at the Japanese yen in bond futures, it looks like, hey, bond futures could be due to make new lows because the yen has made new lows, but this hasn't made new lows yet. When you take a look at copper futures and all these different measurements, it kind of looks like TLT could be on the verge of breaking down. And again, that's really just a whole reiteration of the higher for longer policy. And we're seeing that in price action. Okay, now another notable thing that I want to mention is not only did we reject this 89.50 area here, but we also had this key level that we had tested once, twice, 3, 4, 5, 6, 7 times. And this was a key level in the RSI. And I said, hey, if we break through here, it's going to result in a flush. And when we broke through there, we saw a strong flush to the downside. And that's when we actually came back up and retested this level. And look at what we did. We came back, retested that level, and we rejected it right here. It would have been nice for us to get a little bit of what's known as a scoop and score, right? Where, essentially what you end up seeing is a false breakdown to the downside for a stronger move to the upside, right? So a little scoop underneath, and then you end up scoring and getting a strong move to the upside. We did not see that. We saw a very clean break, retest, and move lower. So very cautious in bonds right now. To me, I don't see a reason to buy unless you're, truly looking to just capture the yields, right? And you're looking to, capture the yield on 10-year treasuries via something like a stock ETF, then TLT, could be good for you, right? But for right now, it's not looking great for longs at a trader perspective. Okay. Now, I'm not saying this to say that, to go and sue me because tomorrow TLT gaps up. It's just rather just be patient, guys. Okay. Look for it to be able to close above 89.50 and use, 89.40 or something as a tight stop loss to manage your risk. And then you can target some of the levels above 92, 93.7, some of these areas to well define your risk, right? And giving you a much better risk to reward ratio versus really just kind of entering in the middle of two key levels. Okay. That's what I want you guys to keep in mind. All right. And really how to look for things and pay attention to things. Now, when you look at the Russell 2000, when the 10-year crosses 5%, 3 months out, it's not too bad, right? It's basically flat, 0.2%. But when you take a look 6 months out, it's definitely not a strong signal for the Russell 2000. So you want to be cautious of small caps. Now, you want to be cautious of certain sectors, right? There are certain areas and certain sectors that have been performing really well. Energy, industrials, materials have been the 3 leading sectors of small caps, okay? So those are some areas where you may want to look for strength and look to potentially buy some breakouts in these small cap sectors. But even when you take a look at the IWM or the S&P small cap index, what you're seeing here is basically a retest of a 38.2% retracement, right? So we had this very strong move from the October lows, and then we come down, and it's very nice to see us on the S&P 600 bounce exactly at the 38.2% fib. And the Russell 2000 is bouncing right along the key zone of the 38.2% fib. If we hold these levels and we start making higher lows, bouncing off of the 38.2% fib is indicative of a strong uptrend. Okay. And so you see, we have this massive move here. We pull back. If I was to guess, this is roughly about a 38.2% retracement. And what do? We make new highs, right? Same thing over here. Very strong uptrend. We pull back. And then what do? We make slightly higher highs. Right. And so if we can hold above these 38.2% fibs, these fib levels on the different indexes, that is a very good sign for us. Now, one thing I do want to note that you need to be cautious of is the divergence that we're seeing. Okay. Remember, these two indices, or, these two sectors, ETFs, whatever you want to call them, they're built differently. Okay. And so you see a strong uptrend in the Russell 2000 with clear higher highs. And then this looks like it was just a little bit of a blow off top, right? Where it's basically equal highs. It peaked above, but that led to a massive downtrend. And so we are seeing a divergence in small caps, where we're not necessarily seeing strong market breadth on an intermarket analysis perspective. Now that's going to wrap up today's video. Hopefully you guys enjoyed it. If you did, smash the like button, subscribe to the channel. Join the Discord. It's $10 a month. There's a link in the description. You can see some of the profitable plays that we've had in the Discord. You can sign up for the newsletter. That's completely free. Link is in the description for that. And you can also get one-on-one sessions with me. We can schedule a time whenever you want. All you have to do is go to my Ko-Fi page, click on the commissions tab, and you can book a 30-minute or 1-hour session. They also have this little buy a coffee button, basically a way to leave a tip or donation for all the free valuable content I put out, such as the newsletter and these YouTube videos. Thanks again for watching. If you enjoyed it, smash the like button, subscribe, and most likely you'll enjoy this next video right here in the top right corner. So go ahead and click on that one too.